Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. It is good to have you aboard today. And my name is Seth Krussman. I'm joined here with Ben Brayshaw, Dan Mickelin. How are you guys doing today?
I'm doing great, Seth. Doing really good. How about you, Ben?
I'm doing good. Just a lot to the Secure Act. Just a lot to the Secure Act. Go ahead, Seth.
Well, there it is. That's what we're talking about today. It's part two of the impact of the Secure Act, and this is it's a massive move for our industry, and it's really going to affect more people than I think people realize right out of the gate. If you haven't heard about this, it's been kind of, the rumblings are out there. And in our industry, there's a lot more than that. We've got, all sorts of education that we're doing. We've got all sorts of other compliance pieces that we're adding to layers of our business. And for the most part today, that doesn't sound like a lot of fun for a show. For one, I'm like, oh boy, here we go. For the most part today, what we get an opportunity to do with you is kind of walk through some of the stuff that are the changes and a lot of things that are pretty cool, really neat. For you as an investor, as a pre-retiree or as a retiree, that are going to make some differences for you. And we cannot wait to jump into that. It's a lot, like Ben said. So without further ado, it's time for Money in the News.
And first article today comes to us from CNN. This is from Laura He. China has an inflation problem. It's way too low, which is quite different from our inflation problem, I'd say. And, we've been talking about this for a while as it's been, kind of front and center in everybody's mind, just the rising cost of living life. China's experiencing something different. And Ben's alluded to this a number of times when we're kind of discussing Fed policy here and the continual ratcheting up of rates and the whole transitory idea, which has proven to be anything but. But there's been mentions a few times in the show about how other countries have reacted to the kind of global circumstance. And it's not everybody raising rates. China's one of those few countries that opted to lower rates, and it's obviously had a different effect. I mean, it's the exact opposite fiscal move, but not to say that it's panning out great there. It's just something different. But they're facing real deflation, which makes them kind of an oddity in the world at this point.
Well, I also think that China has been a country that has their rates have just been, rising. Their GDP has been rising for many, many years at rates. We are like a 3% kind of conversation. We think GDP is good and so forth, but like they're always counting on like 6 or 7%. They run on a much higher scale, and they're used to that in their economy. So I think there's, it's not an apples to apples comparison in general. I mean, there's that piece to it. I think it's interesting. The article says, although GDP expanded 4.5% in the first quarter, that growth largely affected by the impact of the pent-up demand among shoppers following 3 years of pandemic restrictions. Jung added, stripping that out, GDP growth would have only been 2.6. To my point, in the U.S., if we have 3, we're thrilled.
Yeah. The Chinese consumer is a lot different than the rest of the world, for sure. And, part of what they've really struggled with is the amount of debt that they've taken on in order to really be purchasing out. There's been a massive land grab in China, a lot of real estate happening. And one of the things that's happened inside of that is the Chinese people are realizing they've got a tremendous amount of debt. And instead of, think of it, it's compared in some ways to the 07-08 period of time that we went through, where we just had a collapse in our real estate market and a huge amount of debt that was basically unsolvable out there. And the Chinese consumer is just tightening it down. And it doesn't matter if they're throwing cash at them or what. It's just like they're not out there spending. So, yeah, very different economy. And it's really interesting to see how they're in the middle of a deflationary period.
Yeah, they're going through some of the same pent-up demand issues we faced at the kind of the onset of COVID. When, similarly, there's a lot of government money flowing in their direction, but ultimately not a lot to buy, and they're kind of facing some of those same challenges that we went through, which is interesting considering all the stuff we were trying to buy was made in China and stuck there, and apparently the people in China can't get it themselves. So there's really a global issue there.
It definitely leads you to the question mark of whether or not you're going to get your next flat screen TV on time. I mean, there's just a problem. I mean, you're shutting the world down for 2 years. I mean, if you could predict all the problems that you'd have, I don't think anyone has. I mean, there's just so much going on, and then you start adding controversies of Taiwan and everything else inside that. There's lots of concerns going on about facilitating our needs as a country and as a globe, and China plays a massive part in that. And I'm really still very curious about how a lot of this pans out. And it's funny, Seth, because you brought up the point that Chinese have a lot of debt, and that's not the way it used to be, which is interesting because I wonder if they've just assimilated to a very kind of U.S. culture perspective of like having a lot of debt. Meanwhile, we're going backwards. We're creating more savings accounts, and Chinese used to walk in and just buy cars for cash. It was like a big story about why GM was opening up over there, and they were not even worried about interest rates or anything in that space. They were just selling cars for cash. So just something I remember.
Next up, Bill Gross scoops up regional bank stocks. So this is the former bond king, but really the guy from the 70s and 80s of PIMCO that was so much a part of creating that brand. Well, he's said it's extremely difficult for inflation to return to 2%. And in looking at the long term of banks, he sees it as a great buy right now. Thank you for the article by Yi Yi.
Yeah, this is out of Bloomberg, but I thought it was interesting because Bill Gross is a name in the industry that I know the three of us are very familiar with. Perhaps not all of our listeners are, but he's just had a kind of a long and storied past, particularly in the bond world. I think you made mention of that, Seth. So any advice he's offering in kind of the investment spectrum is worth taking note of. But what he's seeing is that given what happened in the banking world, and we've discussed that in a couple of shows here with SVB, and there's a couple other banks lately that are kind of faltering and potentially facing some of these same issues. But he sees the smaller bank indices as having about a 60% reduction in value to what they truly represent. So he sees that as a real investment opportunity. And I think that's specifically calls out Western Alliance Bancorp, Sinvis Financial Group, and PacWest Bancorp. But I think there's some real opportunity there because for sure, like anything else, when a major element of an index suffers, the whole index itself or that ETF or that fund it might be in gets drawn down, even though there's still quality banks included in there.
Yeah, I think the banking world is a really scary space to be in right now in general. Like there's just so many I guess there's so many things going through my mind about banking, right? I mean, if I were to take, the biblical end times one world currency perspective, I'd be like, well, this stuff's all coming crashing together, and then there's the, what next potential 1,000 years before Christ's return, are we going to be like looking at stuff? I mean, there's just so many moving parts here. It's really hard. It's really hard to fundamentally just grab a hold of this. I think as these earnings reports come out for the various banks, looking at what the withdrawals are, what people are taking from the banks, how much deposits are they maintaining is important, and I think that's why Gross is mentioning a number of these banks because he feels like their deposit standards are going to be important because deposits are what banks run on. I mean that's they and I that last line, Dan, do you want to read that? I think that's just very
I thought this was hilarious and just really, quite cynical. But this is a guy I've heard speak a number of times, and it really does fit him. But this is his quote around banking, and he mentions in the article that he's aspired to own a bank a number of different times. He just didn't want to do the business end of it, but the idea of buying a bank in the public market by buying stock in it is something that he's still drawn to. But this is his quote here about bankers in general. Lend money that isn't theirs, charge you interest on it, foreclose on your home if you don't pay it, accept a handout from the government when they get in trouble, and then perpetually complain about bonuses and regulation. The life of a banker, right? Not a bad spot to be in.
Yeah, the last part, would they prefer to be a truck driver? It's just kind of like, these guys really don't have it's not a hard, they get audited all the time, and they get, we talk to bankers and they're like, oh, I got another audit coming. It's like, well, now, they should have been auditing you more.
We did that show, does your bank have a gambling problem? They're literally gambling with our money and charging us for the privilege. And then when things go wrong, they're after your assets. Yeah. They literally have no skin in the game.
Not to mention that, Dan, as with your good credit, you're going to be charged more on your mortgage. I don't know if you saw that.
I saw that, the $40.
Yeah,
that's a good one.
So, gambling more with our money. Thank you.
Helen Reed brings to us from Yahoo Finance. IKEA plans new U.S. stores in $2.2 billion push to change Walmart and Wayfair. IKEA is looking to pick up some serious real estate here in the U.S. and take over some market share, looking at what they see as a softening of some mega market there with the Walmart and then also the Wayfair brand, and bringing to us basically some more IKEA. And it's interesting, the push where they're taking this is more focused in the South. Or at least that's where they're seeing more demand right now.
I always, all these IKEA articles always catch my attention because, I just remember it being this cultural phenomenon. The first one that they opened up here around in New England, I think was the one down in Connecticut, and that was 2.5 hours away. But I remember taking trips down there, and people were just so excited. They didn't care how far it was, that we're going to go on down there, we're going to check out IKEA. And then, I don't know, maybe 5 years later, they opened one, the first one in Massachusetts in Stoneham. And I went down there maybe 3 or 4 months after it opened, and you were still waiting in line forever to get anywhere near that store. So it's just incredible to me with the instant draw and demand and how sensational these things are when they show up. Come to find out, though, here in the article that they've been in the U.S. since 1985. I wasn't aware of that. I thought they were generally newer. And they have about 50 stores. But as part of this $2.2 billion investment, I think the idea I like best is that some of them are they're going to open 9 stores, but I think 6 of the 9 are going to be kind of a smaller variety where you go in and check out the stuff, but then you order it online and it still gets shipped to you. It's not, you don't need to go into, if you've ever shopped there, you see all the items, you got to jot down the item number, then you go find it on these, rows and rows and rows of shelves of brown boxes that are just utterly confusing, just like putting this stuff together. It really is a process beginning to end. It's unbelievable.
I just think that the Swedes expect more from us with that finding the box thing. My wife sends us to IKEA. I'm like, oh, I have no problem walking around the store and pointing to a number, but when I have to go walk through the aisle and grab the cart and
then the best ones in the hardware is in a separate box with a separate number, and you better hope you grab that on the way out.
Oh, I know. It's in a different section. Oh, I've been there, Dan. I've been there.
Brutal.
I'm not sure the Swedes quite understand the American culture yet.
I still prefer it to Wayfair, though, man. I'd struggle with that stuff. No good.
Yeah, I was really surprised to see that Wayfair was a part of that headline. I just haven't quite figured that part out yet. Interesting also to me that the South is really the big area that they're pushing into. I have to assume it's due to probably the online orders indicating this is the opportunity, or this is really the market that's starting to want more IKEA, which, supply demand, that makes a lot of sense. But then they're talking about taking over like Walmart, ex-Walmart distribution centers as a part of kind of that infrastructure that's already built in. I'm really curious to see where this goes. I mean, there's the experience of IKEA is one that you just described beautifully. If you haven't had it, be prepared. This is not something where you're going in for an hour to do a little bit of a shop. And they know that, so they've already prepared. They've got this, beautiful cafeteria for you to try out, not only, typical local fare, but also the Swedish things, which if pickled herring or herring is your thing, more power to you. And then on top of it, they have daycare there too, which I've taken advantage several times because I realize this is going to be a while, guys, and I do not want my kids on my shopping cart, telling me what to buy next.
It's closer to a safari than a shopping trip. I mean, it's like pack a bag and a survival kit because you just never know when you're going to get out of here.
I had completely forgotten about, like, as you're on your way out there, as you're trying to grab all that stuff off the shelf, that maze can be such a nightmare because by the time you're there, well, for me, emotionally fragile is about the closest I can come to describing my state.
It's an experience, no doubt.
Absolutely. I'm not point and click Amazon, my friend. Point and click Amazon. I think they've got a little bit of an advantage, but women like shopping.
Hey, I like shopping too, but I like it under an hour.
Yeah, I would agree. Getting lost in the store. I mean, there's a whole, my wife wants to go back for something. I'm like, I just roll my eyes.
No, well, there's plenty of space to lie down and take a nap if you got to, though, Yeah, don't go against the flow. All
right, you are listening to Money on Tap, and when we come back, we have got more for you in the impact of the Secure Act. It's our part 2. You know what? I also want to mention that if you are coming to us via podcast, or if you're like, hey, what are they talking about? We missed the first one. Go check us out. We're in a podcast format, and you can find us at your Apple Podcasts, iHeartRadio, you name it. We're out there. Just search Money on Tap and go find last week's show on part 1 of the impact of the Secure Act to get caught up. While you're there, if you subscribe, just go ahead. Just subscribe. It's not going to hurt you. Just push the button. Boom. You're done. Go ahead. Send us an instant message. Send us an email at info@yourmoneyontap because we've got some swag for you here at Money on Tap that we can't wait to get you out the door. Get you all geared up at Money on Tap. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We'll be right back.
Folks, it is so much fun for us to bring you Money on Tap. My name's Seth Krussman, and I am one of the hosts here at Money on Tap. I'm also a financial planner. That's what we do. That's what Ben and I do. And the fun part is we get to have this radio show. We talk about important things that we think you need to listen to and be aware of to help raise the bar as far as your financial literacy. It's a big part of what we're trying to do here. The other thing that we're doing here as well, as financial planners, we are welcoming you to come and call us and to join us at Brayshaw Financial Group. Experience what complete wealth management looks like. Let's take a look at all sides of the issue, get a 3-dimensional perspective, and put a plan around your next step. It's so critical. And so many people just leave this part out and then they find out later, if I only would have known. Hey, don't let that be your story. Give us a call at 855-226-8551 or info@yourmoneyontap.com. If you have $250,000 of investable assets today, our plan is free to you. We think it's important for you to know the facts and have a playbook so you can have a successful retirement. Give us a call at 855-226-8551. Thanks for listening.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today we are talking about the impact of the Secure Act 2.0. Yes, it is the 2.0 Secure Act, but it is also part 2 of our Secure Act show. So we are having some fun with this today and really look forward to kind of diving into more about the changes, significant stuff along this path. And if you missed it, there's an opportunity for you to kind of get some Money on Tap gear. All you have to do is send us an email at info@yourmoneyontap.com or give us a call at 855-226-8551, letting us know that you have subscribed to the Money on Tap podcast. And yes, you too can be a Money on Tapper with your Money on Tap gear. With that, we get into today's show for you, and starting off with changes to RMDs, also known as required minimum distributions.
I think with RMDs, it's been around for a long time, and a lot of people don't even realize it used to be 70.5 that you had to take your required minimum distribution, which was the forced distribution that the government required you take from your retirement plan. And that was so that they could force the money out of your retirement plan so you'd pay your income taxes on that money. Because, at some point in time, there's a lot of people out there that, complain about their RMDs because they have to take the money out. Now, if you're fortunate enough to have to complain about the taxes to take your money out of your retirement plan, the government's forcing you to pay taxes on, consider yourself of the better side of retirement. But the RMDs were really designed to, basically for the government to force a kind of a consistent income tax revenue stream, for the government to make sure that the retirees who built up this huge amount of wealth that's been tax deferred, that went in tax free for, 40, 50 years, that they could get their hands on a portion of it. So the RMDs moved up to 72. And with Secure Act 2.0, they're moving it up even further. So I was doing some math on some of the actual, language around this, and hopefully I'm correct here. Correct me if you're wrong, listeners. A lot of you like to. So, but if you're 64 today, or you're between 64 and 72, basically, you're going to be a 73 RMD. So at 73, you're going to have to take your RMD. It's going to move from 72 to 73. But it advances further. So if you're younger, if you're 62 to 63 years old is what I did the math on, it looks like your RMD is going to be 74 years old when you have to start. You're going to be forced to take money out of your retirement plan. And then if you're 61 or younger, it currently looks like it's going to be a 75 RMD. I think the one thing that I think is suspicious about this is that why do they keep pushing the RMDs out later? And I really, I guess maybe I'm just the biggest pessimist when it comes to our government and what their goals are, but I always think they're sleight of hand on some level. So take that for what it is. But I think that the longer they delay this, the more opportunity they have to raise our taxes, our income taxes, which is how your RMDs are going to be taxed, or lower the bracket in which that bracket starts. So if your income tax bracket starts at $40,000 and it's 12% a single, if all of a sudden the 22% bracket that starts, there, if you're maybe dropping that down to $30,000 and that's when 22 starts, maybe your RMD is going to push you into that space. And I think that's another scenario. But I also think this gives them time to adjust tax brackets that are at basically historic lows for the last 100 years.
And the other thing is, a lot of this calculation in terms of not when you begin your RMDs, but how much you need to take out is life expectancy driven, right? And life expectancy is dropping here in the U.S. So they're pushing out the age in which you need to begin the withdrawals, but the math around how much you need to take each year based upon
it's going up.
That further deferred growth and the shrinking life expectancy, you're going to have to take out more per year.
Right, which is going to force more money out at a higher bracket. And when I talk about being at some of the lowest tax brackets, I'm talking about the top tax bracket is at some of the lowest it's ever been in the last 100 years. I mean, it's hard to believe, but the top tax bracket in the 50s, I mean, and if you don't believe me, go Google this because this is going to blow your mind out. But the highest tax bracket used to be 92%. That meant 92 cents of every dollar when you hit the top bracket was going to the U.S. government. And like, it's hard to feel bad for somebody who's in the top tax bracket, but the way they're moving all these things around and adjusting them, the people who are impacted the most with even just the new Biden presentation of budgeting and stuff, like where the tax brackets are supposed to go, it hits the person it's basically a small business guy who makes between $200,000 and $400,000 a year. And, that is the guy who runs your small business. So it's really hard knowing that these things are going to be huge impacts.
And it's also interesting to note that is really, depending on what your perception is here, but that is the upper middle class or the middle class. It's not out of sight numbers for the majority of what, money used to get you, right?
Yeah, $200,000. It sounds like a ton of money, but, you have a guy who works for a tech company and the wife's a teacher at the local school. By the time you're done, you're probably about $200,000. It's hard to believe when you start looking at all the numbers and how things pour in, and you work a little side job and you're doing this, and it's like, oh yeah, you have to. Here's your Social Security self-employment tax. So there's just a lot of moving pieces here.
Yeah, it's not wealth when we think about like what wealth is, and we're not trying to attack one direction or another. It's just it kind of is what it is, and you're right. It is affecting a class or a denomination of people that we've been sold something different. I think we've been sold a lot of different stuff, and I'm with you on that, Ben. And I also I completely agree when you're talking about now, Dan, that's something that I really haven't paid a whole lot of attention to. But when you say that we have a life expectancy that's getting less and less in the U.S., it's baffling to be in the U.S. with all the advantages that we have here, and life expectancy is decreasing. Infant mortality is decreasing or is increasing. Excuse me. There's numbers here that we take a look at and we're like, what country do we live in? Why is this? And well, there's a lot of lifestyle things that we can take a look at, for one. And it's a bigger conversation than just the numbers that we're looking at today. But yeah, there's definitely law of large numbers tells us there's a reason that they're doing what they're doing. And they're going to go ahead and start collecting those taxes, as well as we talked about the Roth last week. We talked about the Roth, or the Rothization of the 401k, where there's a lot of those dollars that are catch-up contributions that are now going to be taxed because they're all going to go into the Roth. They're no longer going to go into the traditional 401k.
There's no doubt that the government is pushing us towards a kind of do-it-yourself model. And we spoke last week about how the kind of private enterprise world went through that with the reduction and then elimination of private pensions and more of a defined contribution model, whereas it's the funding that gets determined, not the outcome. So that's it's a transference of risk was the way Ben put it, and I think that's appropriate and that's right on. So the expectation's going to be, as far as retirement goes, is we're more on our own than we've ever been, and it'll continue to be that way.
Yeah, and we joke around, it's a secure act. it doesn't add any security to your life. It only obligates you to do certain things, and they're going to get more of their hands on your money in requiring what you do. And then I think on top of it, these target date funds and all of the different pieces that are moving here, I just see very much of what Obama was trying to present way back when, which was starting a Roth program, his own version of a retirement program that was Roth-like. I believe it was. I can't remember. It never really got off the ground from what I recall. But there was a number of different government-managed, government-funded, government-run retirement programs. And I really see this thing kind of being enveloped. I think the Secure Act 3.0 or 5.0 or 10 or whatever, here's your iPhone 4000 and here's your Secure Act 10.0. We're going to take your 401k or your Roth or a portion of either of those or both, and we're going to bring those into a Social Security system because Social Security system is crashing, and we're going to bring it all together, and we're going to offer you one retirement plan. Again, more of my conspiracy theory, but I think there's some real reality to this where the government's going to say, hey, you have XYZ in your 401k, which would produce, let's say it's $2,000 a month revenue. Your Social Security was going to be, $2,000 a month. That's $4,000. If you sign up to bring it all together, we'll give you $5,000 a month. You're going to get, a 20%, 25% bonus on your retirement plan by surrendering yourself. And by the way, inflation's now, 8%, whatever the story is. Like this is only the next step, right? This is giving over your second largest asset, or what will become your largest asset, to the government. This is very concerning to me across the board. And I'm not a big fan of more government involvement in this stuff, because I think it's just a very slippery slope where, hey, the target date funds didn't work, the market crashed, you ran the dollar into a zero value, you've alienated Russia, so now everyone's trading oil outside that. I have this $500,000 401k, but now it's really worth $300,000 with spending power.
With 25 Fed coins or whatever.
Yeah, exactly. And I really think this is like everyone's going to be in crisis saying, I don't know what I have and I need to, and people are going to sign right up. I'd rather have 25% more than what I have now, and some number I don't know what it is, and here's my 401k. Yeah. And that target date fund's done nothing for me.
There's no doubt they're building in lots of options here, and the 401k has gotten a lot more complicated. Good, bad, or indifferent, I'm not sure. I think time's going to tell. But there's not a lot of good track record in suggesting the government.
What do you think they're going to do? What's in the back of your mind?
I don't know if the total grab is the play. I think it could potentially even go the other way around, where, individualization of what you do contribute to Social Security, you can add that into your 401k. The question is, are they after total control or total exodus from the risk that they own?
Well, I just look at it and say to myself, if I was in the government's shoes, I'd rather sound like I've got the big winning play than I have the big losing, fumble. I mean, at the end of
But if they crash that, like they crash Social Security, what's next?
Yeah, but the thing is they don't have to prove they're going to crash this. We know they're going to crash it, but if Social Security is crashing, and the last grab to bring trillions and trillions of dollars into one system that then floats up Social Security and your retirement on a promise to pay again, then they've just kicked the ball down the field, for more football analogies, to the next, to another 10 generations.
Yeah, I guess this is getting way off topic, but the next election cycle, or the couple to come, I really want to see what people's plans around Social Security is. That should be what everybody votes on. No one's
going to run on Social Security stand. No one's going to come up with a good story. Hey, we're running out of money in 2032, so we have to raise your taxes.
Oh yeah, it's concerning how they'll get there, because you're right. There's limited ways. Tax more, spend less. But for people who are truly concerned, who aren't of Social Security age right now, putting your vote behind and your mind focused in on who's got the best plan for that, if you think it's a relevant piece of your retirement, is just got to be really important.
There's no way to create assets. I know the government can print money, but there's no way to address the financial need to cover the shortfall of Social Security. I think they really need to find substance to bring everything together, and I think that's why they're looking to tax now. They're looking to do the Rothification to create more tax dollars today. I think the idea that bringing in everyone's retirement plans, or just the Roth, and saying, hey, here's your social Roth, is a scenario. The other piece that concerns me is, how do they get their hands on the Roth money if everything's tax-free? I want to talk about that next.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about the impact of the Secure Act 2.0. It's a part 2 of a 2-part show, too. And you can also subscribe to Money on Tap at your podcast venue out there. And let us know. Send us a message. We'd like to send you something so you can get your Money on Tap gear. Lots of fun stuff coming down the road. It's interesting because where we're at in the conversation is a bit of an inflection point, because we're talking about strategy. We're talking about the way money moves. We're talking about the hypothetical of what could be coming. Ben has talked about where taxes were at 50 years ago, and the rate was for the top tax tier was astronomical. When the IRA was rolled out as an option, and the benefit of saving tax dollars on the way in was an option, people were ready to embrace that because of where the tax brackets were at, especially. And the idea, as taxes started to decrease, was put it in, save money today, and when you draw it out, you'll be paying less taxes because your income will be lower. You'll be at a lower tax bracket. So we could see all those things kind of just on a chart as we're following along. And what we're looking at today is very similar. We don't have we don't really have like a look back for us to be able to say that's what's happened and that's what we should have done. Right now we're at a place where we're looking forward, saying what are the tea leaves, if you want to look at it that way. But it's more than that. It's like, what's the reality of why we have the options we have today? And let's explore what some of the potentials could be. Ben?
Well, I think, the Rothification or the Rothing of our retirement, however you want to phrase it, there's a lot of like little taglines of what's going on. But the reason there's a lot of taglines is there's a lot of movement of money from that pre-tax arena, that pre-tax 401k, that traditional IRA, the SEP IRA, the simple IRA, to some form of after-tax events. And Dan, you pointed out that the government needs tax dollars today. That's a fact. The more tax dollars they can garner today addresses the increased budgetary issues with just the cost of servicing our debt, nevertheless the Social Security failure that we have and we're staring down the barrel of. But the Rothification of today means that we have all this money. Roth, you put in this after-tax dollars or this converted taxable event dollars that grows tax-free. So if you convert $100,000 and now it's worth, $400,000 20 years down the road, and, you're super excited, it's all tax-free coming out to you. How's our government going to manipulate the events around all of this to address the idea of how they garner more taxes? I mean, there's a ton of growth there that, they don't like. I mean, it's that's why step-up cost basis, I mean, if you're familiar with that term, has been a constant debate in the background of Congress from time to time. Like, how should we give these people this huge gain to pass on to their children without paying taxes on it? And same with the Roth, and that's one of the things. I really do believe, and we've chatted about this a few times, I think that a federal sales tax is coming. I think it's not today. I don't think it's tomorrow. I don't think it's even 2030. I think it's 2035 or sometime down the road when there's trillions and trillions of dollars in these Roth programs, because that's the only way they'll be able to get you to pay taxes on the dollars you're spending. Now, the problem with that is, well, if you have a normal 401k that's still pre-tax, that's not been Rothified, then you're going to pull that money out, pay some form of income tax. Then you're going to go spend it somewhere and you're going to pay federal sales tax. And people say, well, that's crazy. But we already do it at the state level. We already pull money out of our 401ks in retirement and we go down the road, not New Hampshire, because there's not sales tax unless you go out to dinner or, get a hotel room, but in most states, you're going to pay state sales tax. And that's a secondary tax on money. And no one thinks twice about it.
Yeah. I mean, there's got to be something done. There's no doubt about that. But, maybe it's some combination of the federal sales tax, a flat tax, and the elimination of the IRS. That's a big budgetary boon, right?
I like the latter of those.
But, the bottom line is that there is a massive problem here, and there's going to be a couple of addresses that the government's going to be forced to enact. And it looks like with the Secure Act, they're kind of setting themselves up to create some options for down the road.
Well, and I mean, when we talk about Rothification and the Rothing of the world, I mean, it just goes right into the next item, which we have here, which is 529s to a Roth IRA conversion, which is the next point, something that's totally new. They're basically allowing you to take a 529 plan that's not, been underutilized. So if your son's or daughter is brilliant enough to get a full scholarship and you've spent all this money on this, 529 plan, they're now saying that
I got to point out the obvious there. That's not the only reason that there may not be college expenses. It could be the other way too.
I'm going with the optimistic side instead of the pessimistic. I'm trying to swing here.
Your optimism threw us off. We're not used to hearing that from you.
Sorry about that, boy. Sorry. Well, for all our listeners, they're all children are brilliant. So I would only assume that, if they're listening to us, they have to be brilliant children.
Or fantastic athletes, one or the other.
Oh, yeah, absolutely. Those are the only children of our listeners. So you can actually start doing a Roth conversion up to the beneficiaries, allotted Roth contribution limits. Or I guess it's considered a Roth contribution. This is one of those areas where they say we're coming back to give you more details.
Right.
And so that was kind of interesting in all the stuff from the Secure Act 2.0. But you'll be able to convert up to $35,000 saved in a 529 plan to a Roth IRA with no penalties. And so then it goes on that, it's based on the annual contribution limits of the beneficiary, but it's for you. So, like, if your child's, Roth IRA contribution limits are $6,500, the current writing looks like you'll be able to do a $6,500 Roth contribution on behalf of yourself with their 529 plan money. But we'll see how this all pans out when they're done.
And as it's written right now, the 529 needs to have been open and funded for 15 years at a minimum. So this is going to be kind of a late decision right up at those generally college entry age years. But one of the strategies that's being suggested or considered here, that coincides with the Secure Act is to start overfunding those 529s. Open that opportunity for yourself.
Get that going. I mean, my poor kids, I should have done it for them. They're not listeners. So, but I think again, the Rothification, why is the government pushing us into Roth programs? Why is that going to be coming? I think they're going to literally wrap this thing up because they're going to say, we let you do this. This is all tax-free, and we're going to give you your Roth and your future Social Security benefit together. Something's going to happen here. National sales tax, culmination of funds, the commingling of the government's assets and yours. Something's coming, folks, and I think that's what's the red flag in my mind. And you guys may disagree, but that's kind of – I feel like there's more to come.
I'm holding back. I'm holding back. I think we've got a couple more points before I roll out. It's not my plan, right? But it's very clear. I think we're going to actually look back here in the very near future and say, they told us. They told us with that Secure Act 2.0 what their plan was, what they're doing. Because I don't think I've ever seen so much happen that opens up one clear path in the legislation around retirement as this 2.0 does. There's other pieces in here that we're going to cover as well that are pointing more towards that Roth. I mean, I love Roths. I feel like I'm about to jump on this bandwagon. Not that I just feel like I'm about to start discouraging people from Roths. Maybe I'm being a little discouraged myself or dissuaded myself at this moment. But there's more. Let's go.
Yeah, and just on that note, before we get into a couple more changes that happen to be, believe it or not, Roth focused, we are all, I think, as planners, big believers in Roth IRAs. I mean, this is a conversation we have every day with people. So
we love Roth IRAs. That's the problem. It's like it's so irritating because it's look.
Don't you dare touch our Roth.
Yeah, I know. So I'm thinking to myself, my word. I mean, if they start attaching our assets to Roths or start sales taxing them or whatever they're going to do to, quantify, dollars to the government, then I just don't know. But I mean, Dan, go ahead.
Yeah, I mean the kind of the newest Rothification technique here is beginning in December of last year. They allowed for employer matches to be designated by the recipient to either be traditional or Roth, right? So prior to that, an employer match could not be made into your Roth 401k. And a lot of 401k plans would have an option to do the traditional route and receive your match, or you could divert Roth dollars that way, after tax. And we've encouraged people to look at both, pretty consistently over the years. But news got even better for that Roth end because the match can apply.
Yeah, and I think another thing that was Roth focused is there's no more RMDs for Roth 401ks, and I think that alone says you'd have to remove whatever obligatory taking funds out of your Roth to do to bring everything else into another program. I think that's very interesting. So
you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about the impact of the Secure Act 2.0. Hey, if you're a podcast listener out there, go ahead, hit subscribe. It's okay. Nothing bad's going to happen. You just hit subscribe on the podcast. And guess what? Send us an instant message. Let us know. We want to send you a thank you gift for subscribing to Money on Tap. Get your Money on Tap gear with us, and we will be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Talking about impact of the Secure Act 2.0. You guys have spent a little bit of time kind of weighing in on the scenarios or what possibly could be coming down the pipe. I get it. There's going to be a whole lot more Roth money out there in the world. And as things transition, people either use those Roth monies for their retirement income. How do they become taxed? Because it's such a critical part of our current environment. What's necessary to keep everything running is taxes. And that's a lot of money out there. They're starting to pile into these Roths. My idea is, and I hesitate to say some of this stuff too, because I don't want to kind of throw it out there and give anybody the idea. And I realize at the same time, that's kind of ridiculous that anything I say here is going to turn into legislation. And I think that they're going to start to go ahead and attach taxes on the estate plan, on the estate side of things. I think on the way, you know what, you're going to go ahead and get to use that Roth as much as you want, tax-free. And then when you pass away, guess what? They're going to go ahead and attach taxes to those. So I think that's how they're going to go ahead and start to get the money back out of these.
Yeah, I think we can speculate 1,000 ways over. I think we all agree there's something coming down the pike. We just don't know when and what. But what was the phrase you used, Dan? The
consolidation.
Just the whole consolidation. But you said something else too, and I was like, yeah, just like they're bringing it all together. It's very, very. It's a funnel. The funnel's wide. We're at the top, and we can see it because we're in the industry. We can see it kind of colliding together and getting ready to be pushed out the other side. So, but like for instance, if you think about it, like they're creating like all these auto things, like you're automatically enrolled in a retirement plan and you automatically have 3% withheld. We talked about that last week, right? But they have automatic 401k transfers because people bounce jobs all over the place. So they're starting out with like, hey, you got all these 401ks and you've left all these different jobs. It's a lot for you to manage, and it's not. But if it's under $5,000, boom, we're going to move it right to your next 401k. Like next thing is it's going to be not 5,000, it's going to be 25,000, and next thing you know, it's going to be an obligatory scenario where you're moving 401k to 401k to 401k to keep all that stuff together. I mean, they're putting all these things that used to be choices and buttons into very simplistic. We're going to take care of it for you. We're going to manage it for you. We're going to do it for you. And that concerns me because that's a whole heck of a lot of control that they're giving themselves by voting.
How do you know that you've been traded to a new company? Well, you go to log into your 401k and it's not there. And there's a new login saying you no longer work here, you work there.
Yeah, exactly.
401k is going to be like a mortgage. It's tough to track down,
Yeah, exactly. Well, it will be. It'll be the government's hand, so we'll know exactly where it is. Yeah, it's just interesting. And then, we talked a little bit about these target date funds. I really do think that, the Secure Act does address these, and it does require expanded regulation on them. And that's because and people say, well, why do you bash target date funds, Ben? And it's like, well, fee after fee and layered fees, because target date funds are just, it is a fund of funds. So you're paying all the sub-fund fees that it's bringing together that you could have prior purchased each individually, and then you're paying an additional fee for this kind of thought process of we're going to put all our funds together, and they're double charging you most of the time. And then the risk, scenario is variable. So not everybody who's going to retire in 2040 is going to be in the same risk category as each other. So there's a lot of stuff. So there's all this additional regulation. And honestly, if they can see it and I see it, then there's something maybe if you're in a target date fund you might not see. So, give us a call. I'd be happy to chat about that.
But, the change here is, I think, a relevant one where it's going to be, as you receive statements, if you happen to be in a target date fund, they're going to have to give you a benchmark return rate, which simply says, how have your returns been as expected against a similarly structured kind of benchmark fund. So it's tough to compare a target date fund to the S&P 500 because a target date is going to have a mixture of bonds in it, right? And the S&P 500 strictly equities. So there is going to be something that we can at least use as a basic comparison to compare other target date funds to what some expected result might look like.
I'm thinking savings account that might not even be.
But yeah, I'm concerned a little bit about how they're going to build this benchmark, because that's complicated and exactly what does that look like. But it's information I think ultimately be helpful. I just hope it's done with a kind of an honest outlook.
Yeah, agreed.
I like this one. I'm glad there's something going on in the background here to address the issue with the target date funds. The last one that I had here was the employer match for student loan payments. And one of the biggest hurdles that is inside of the contributors to the 401k employees is student loans and the amount of student debt that's out there and what's necessary to repay that being the priority or the emphasis of what needs to happen first before starting to contribute towards an employer program or a 401k program. And what they've done is they've said, look, you're going to continue to repay your student loan, but we're going to make a match that student loan repayment eligible for the employer to match. So let's say somebody's making, for instance, $60,000 a year. They're eligible for an employer match of 10% if they contribute $500 a month to the retirement program. Okay, but they feel like they can't afford it or can't contribute anything to the retirement account, right? Because of the student loan, it's $500 a month. So previously they, just would have been out of luck, but they can still put $500 a month into their retirement account as an employer matching contribution. So it still allows for them to participate in the employer match program. I don't see anything wrong with that. I don't have an issue with that yet.
I don't either. I mean, if they're going to pay $500 to their student loans, it's better than me paying $500 towards their student loans, and having the government swallow those. But if the employer can still then match based on that, and the employer is going to match either way, whether they
it doesn't matter to the employer.
Yeah, it doesn't matter to the employer. It allows the employee to do a little bit of both and not feel left out in one or the other. I generally like that, and I think it's a win for everyone, including even the taxpayer who doesn't have those student loans.
Oh, that might be your favorite government program I've ever heard of right there, Ben. Holy smokes.
Tax cuts are my favorite government program.
Oh, that's true.
Less regulation. There you go. Folks, you have heard it here at Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we'd appreciate that you have spent the time with us today. We've kind of given some incentives for you to go ahead and get some free Money on Tap gear. That's fun. That's great. What about you? I mean, outside of that, what about you and your retirement? We welcome you at Brayshaw Financial. Give us a call. We want to make sure that you get the time and attention that you need to put together a plan for you and your retirement. It is critical. And it's an honor for us to be able to be here with you today and also down the road as we do the planning work together. And that's it. You don't have to do this by yourself. Okay? We're here, and we love the opportunity to help you. We look forward to hearing from you. Be successful in your retirement and be successful in your investing. We'll talk to you soon.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.